All right, so welcome to this introduction course on futures and trading. I'm really excited. This is a passion of mine. This is something that I have put a tremendous amount of work and years into developing, and I'm really happy to share what I've learned with you guys and you guys here today. What can we expect from this full course, which will take several days to go through and whatnot, okay? First, we can understand what markets really are. Okay, I really want to emphasize what markets really, truly are. What drives them? How can we participate in them? How can we read what we call a DOM, order flow and whatnot? And what participants are doing? What kind of orders can we place in markets to participate in them? Then we'll learn a bit about futures markets specifically, how they work, and again, just some of the details about that market and how we can trade it. Then we need to understand risk. We all know in this room here, risk is absolutely pivotal and crucial for trading, and therefore we need to spend some time talking about it. And then I think what I'm really most looking forward to is talking about our belief systems and whatnot with trading. I really understand that, especially for you guys that are just starting out trading, if I can talk to you about your belief systems, if I can talk to you about the way you think about trading from the get-go, before you go down the normal path of destruction and pain, we can save you a lot of trouble and have you much more successful much sooner. Then we'll talk about how we build charts, okay? And then we'll talk about how we analyze charts. We'll talk about using statistics, measuring our performance. What are some crucial components there? What's most meaningful to us as a measure of our performance? And finally, we'll bring it all together, come up with a way to actually get started. That's one of the things that I hear people reach out a lot about. How do I actually get started? How do I choose the platform I use, the broker, my trading style? How do I find my niche? We talk about that here. And just begin to get your feet wet. So let's dive in, and today we'll plan on covering what markets really are, a bit about futures markets, and we'll talk about risk. This course is not a course to teach you a methodology of how to trade, okay? I plan on having that in the future, but that's not what this course is. This is not a course to get rich overnight. No course, any course that tells you that that's what it is, run away from it, okay? Trading is hard. We all know that in this room here today. And this is not a super in-depth knowledge of futures and the history of futures markets and why they exist. I really just want to give you a practical working knowledge and understanding of futures markets. So a brief introduction about myself. My name is Merritt Black. I am from rural Alabama, and I fell in love with markets at a really young age. We had not even a competition, but just a thing we did in the 6th grade where the teacher asked us to bring in the newspaper each day and simply highlight stocks, the tickers, in that section, and look at how they fluctuated and whatnot. And as a 6th grader, I thought that was the most amazing game or something to figure out that existed that I'd ever heard of. And so at that age, I went to the bookstore, got books on trading, and started to read about trading. I feel like I got a bit lucky in that the first book I bought, I'm sure I just liked the cover of it. I remember it was a blue cover and had some pretty kind of picture on it. It was a book called Rolling Stocks by Gregory Witt, and it taught this concept of there are certain stocks, you can look at the charts, you can look at fluctuations in those and essentially find support resistance. I don't even think he called it support and resistance. But I was immediately, unbeknownst to me, indoctrinated into the world of technical analysis, of reading charts and looking at price action at a young age. I didn't even know any other way. I could have went and picked out The Intelligent Investor by Benjamin Graham or something, and maybe I would have gone down a fundamental path and whatnot. But I'm really glad I went down the path I did. Now, being from rural Alabama, I'm on an island, man. I got nobody. This was before we even had the internet at our house. And I really was on an island and alone and whatnot. I went to college as a molecular biology major and thought that I would really be a researcher and whatnot, but I was just trading as a hobby, right? Something I just loved doing. And then I saw this movie, The Pursuit of Happiness with Will Smith. I changed my major the next day to finance just to get a background and build what I could to begin selling out totally to trading and investing and whatnot. And since then, I've been involved trading professionally for multiple prop firms, started a CTA. I've had failures. I've done all kinds of things and have a wealth of experience that I hope to bring to people. One thing I really love about trading is it uses both sides of the brain. We can be very, very analytical, very numbers oriented, and we can also be very creative in terms of using our subconscious pattern recognition and how we decide to view the markets and create filters and beliefs, which we'll talk about later. So my goal for you is to share all this with you, help shorten your learning curve, introduce you to things the right way initially, and save you some time and money and energy. So welcome to trading, welcome to markets. Everybody in this room is totally in love with it, including myself, so welcome to this adventure. So let's talk about markets. Markets are an auction process, okay? And we're going to define that and talk more about that. I want you to understand how markets move on a big time frame, a macro perspective, as well as the tiniest time frame possible, the micro perspective, individual buyers and sellers and how they're reacting and transacting with each other. We're going to look at how you can place orders, order types we can use to trade, how we enter and exit positions, and really what it all comes down to. What is trading and what are we after, okay? We think money, but we need to think about it differently. So, markets are an auction process. I want to remove you from even thinking about markets in terms of the stock market or futures markets or anything right now, okay? We could think of an art auction. We could think of the lunch you bought today, anything where there are buyers and sellers and there's a market that creates some type of negotiation for prices and whatnot. We're going to take a look at various things that happen, markets moving higher, lower, establishing value, new information coming into a market, and how we can view that within an overall context, and how we can determine what's happening truly in a market. So, I want us to talk about, we have a picture here of a Honda Accord. We're going to focus on the market between individuals and maybe companies that buy Honda Accords and the dealerships that sell them, okay? We know that when you go to buy a car, there is a little wiggle room. There's some negotiation that can occur, right? And so it is really what we would call a two-way auction, which is what markets are financial markets are like, okay? So when we first have our market, we begin trading and we begin doing what we call establishing value, okay? So I actually want to bring up paint here. So, price of a Honda Accord, I think, is around $22,000, okay? So, on our price axis here, 22,000 is right here, okay? And what happens as we begin to trade this market, there is a transaction that occurs at 22,000, okay? And then Ricky goes into the dealership, and Ricky is a sucker. Okay, he has no idea.
He's got money.
He's got money to blow. But he has no idea what the price should really be very, very precisely. And they say, oh, yes, sir, this is a fantastic car here. We'll sell it to you for $24,500. And Ricky said, man, I like this car. Sell it to me. So Ricky buys it for $24,500. Dennis comes in. Dennis is very astute. He has done his homework. He knows the pricing very well. And he says, I refuse to pay anything over $23,000. I know your cost as a dealer is $19,500 and you're still going to make a good profit off of me. That's all I'm going to pay. And so Dennis transacts there. Okay? And then we have other people that come in and get a fair price, and another person here and here and here. One person way down there gets a, their brother-in-law is the dealer or something like that, right? But what we start to see happen is we look at the only three components that exist in a market, which is price, time, and volume, okay? These transactions occur over time, okay? They occur at a specific price when they occur, and we can start to sum up or tally the volume of transactions, that occurs at each price. So what we're doing is, I'm going to show you is establishing an area of what market profile people, which is what I use, call value, okay? And it's different from value of like a value investor. That just means you're trying to get something for cheap, right? Value is what, as we start to show a graphic of what this would start to look like if we were to draw where the volume is occurring, there would be very little volume. Here's the axis. I'm going to draw it to the left. There would be very little volume that occurred at any of these prices. And as we got closer to 22, there's where the real high volume is occurring, where most transactions are occurring, okay? And then as we get lower, there's less and less volume, and then it really dries up down there, okay? So, you look at this as a distribution, as a profile, as we call in market profile or volume profile analysis. This is really what markets are. So let's talk about really why that occurs on a very kind of detailed basis. What happens when price goes higher, okay? Let's say that we have real-time data piping into our computers and we're looking at this car auction and the dealerships are giving us the information and buyers and sellers are coming in. What happens as price goes higher? What happens as price goes lower? As price starts to, let me delete this. We're trading around in this area, and as price starts to trade higher, there's a dynamic that happens between buyers and sellers. Buyers start to say, wait a minute, right? Unless they're an absolute sucker like Ricky, who has no information and has their blinders on in the world and just doesn't know, they're going to start to say, wait a second, Joe Schmo bought it for 22 and I'm about to pay 26. That doesn't make any sense. Less and less buyers are willing to pay higher prices. Plus, it just simply gets out of people's price range and their budget, right? Less people start to buy. So the volume dries up there, especially when we think about just from the buyers. The sellers, on the other hand, as a seller, you want to sell something for as high a price as possible. So they say, bring it on up here. So the sellers get very, very competitive for the very few buyers that exist at these higher prices. And the sellers drive it back, right? They say, oh, you want to buy it? Boom, I'll take it, I'll take it, I'll take it. And so price, less and less transactions occur up here, and it reverts back into this most traded price area, okay? The same thing happens on the downside. It's exactly the same, except in this case, we're going down, 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 down. What's going on from the perspective of buyers? Getting a deal, right? Buyers are saying, heck yeah, I'll buy as much as I can down here. I'll be very aggressive about that because it is a great deal. What about sellers, though?
They don't want to sell. They're
Yeah,
not making money.
they're not making as much money, so they're more reluctant to sell. That volume from their end is going to start drying up. And we can see that represented by volume at price, okay? Very, very powerful concept. And this is really how markets work. We could look at car sales for the past year, and you will see an area of value established, and you will see volume dry up above and below. Now, what about when we have new information? Okay, so let's go back to our example. I'm going to start fresh here. So let's say that right here was that all that volume that was trading at 22,000, okay? Normal auction process, the market's doing its thing. Something happens, and we'll need to simplify the example a little bit because it's a complicated one, but the wheels are falling off Honda Accords, okay? We have new information that hits the market. There's something wrong with this product. There's no such thing as a recall, which would obviously happen or whatever, but you know, if you buy a stock and something goes wrong with that company, there's no recall for you there, right? It is what the product is. So we're going to stick with that here. Where's price going to go?
Yeah.
Price is going to go down, okay? Now, let's say that it takes around $10,000 to fix those broken wheels and get it back to a new car. We would guess the price would probably go down to around $12,000, right? So we're trading. News comes out, boom. We go fast, right? We trend. These are big opportunities for traders, right? And then what happens when we get down to around 12? What happens next?
We create another volume area.
Exactly. The market establishes a new value area, okay? And we can start to see that happen. All this volume that just drops out real quick, it's going to be fairly thin, right? In terms of a per price level, because we're covering a lot of areas. They can be high volume moves, but in terms of how much volume is trading, it's not going to start to build up a fat distribution, as we call it, okay? But it's going to come down here, and then all of a sudden it's going to start to stabilize, and we're going to form the same thing where as we drift back up, those prices are too high. They're going to revert back to value. If we drift below there, back, okay? And we will form a new volume distribution around this area, a new area of value. Now, let's take it an even step further. I believe this is the next slide. What happens if, just bear with me, the wheel problem was fixed? For some reason, the wheel problem no longer existed. What is the market going to do? Exactly, precisely. Not just go up, okay? That's base level understanding. The market's going to go up. It's going to revert back to a prior area of established value. Crucial trading concept. Price is doing this thing. Whoop. We are looking at this zone here, a prior area of established value. It is going to oftentimes revert back to what we call the point of control, or the most traded price from that area of prior value. This is how markets move, okay? Auction market theory. Here's an actual graphic looking at actual market profile graphics. Each one of these represents a day, each one of the little blobs or distributions, if you will. So even within a single day, I can see where volume is thin, where it's drying up, and where it's actually building value and whatnot. We can look at how that moves over time, and then we can look also day to day to day. Are we trending? Are we imbalanced, as we call it? Or are we establishing value overall in a general area? So this shows both happening in this picture right here. If first this market has some new information, it's heading down. The wheels are falling off, right? We're heading down, and then we get to an area where we start to reestablish value lower. So now let's get into the actual nitty-gritty of second to second, transaction by transaction, how this unfolds, okay? This is what we call a dome. Now, most of the guys in this room trade stocks, and so you're actually used to seeing two columns instead of one price column with buyers below and sellers above. But this is how people that trade futures look at level 2 data or the dome, okay? Now, some people call it an order book. If we start to look at it, the center column here is our prices. That is where you can buy or sell, okay? a concept you want to learn right now is something called the bid. Okay, the bid is where someone is willing to buy. Okay, and bids are always below the current price. Okay, we'll talk about if a bid is above the current price, what happens with that later. But these are people we can see at what price they're willing to buy, and the numbers 7, 17, 33. There are 7 people willing to buy. We'll just call them people for now. 7 people willing to buy at $53.70. That's the best available bid in that market. What we call the ask or the offer, you can use either term, is just the opposite. It's the sellers. Okay? It's where they're willing to sell, at what price they're willing to sell, how much they're willing to sell there. So the best available offer or the ask in this market at this snapshot in time here is at $53.71, and there were 23 willing to be sold at that price. This is how we view participants interacting and willing to trade at certain prices in financial markets. There's such a thing as a bid-ask spread, okay? As we can see, there are 22 willing to be bought at $1.52, and then the best available offer is for 11 at $1.59. So we have what's called a spread, a bid-ask spread from $1.52 to $1.59. There's a gap between what a buyer is willing to buy for and what a seller is willing to sell for, okay? Now, this really comes down to liquidity for the most part. And liquidity is simply how many participants are participating in that market at that time. So if we think of something like the housing market, right? If you want to sell your house, you will have an offer at a certain place, and someone will come in at a bid that's $30,000 different than your housing price, right? So there's not many participants in your particular house that market to buy or sell that piece of property in that house, right? So it's very illiquid, and so you'll typically have spreads between where people think it's valued. A market like crude oil, for example, or the S&P 500 futures, which we'll talk about both of those, extremely liquid, vastly liquid, and you rarely ever see any type of spread. They're always just 1 penny away, just willing to trade with each other all day long. How does a transaction get done? Okay, so far we've just talked about people willing to sell higher and willing to buy lower. How does a single transaction get done? Someone must get aggressive. Okay, that sounds simple, but if you're at home, write that down. Someone must get aggressive, because as you go through these courses with me, we're going to begin really studying how to read aggressiveness from buyers or sellers, and that's going to determine what we do oftentimes, okay? This could be an existing buyer that says, such as I kind of have highlighted here, someone was willing to buy 10 at $155. Someone is willing to sell 15 at $156. And the guy willing to buy at $155 finally said, you know what? I'll pay what you want. I want it. And he's going to move that order, and he's going to go to $156, and that transaction is going to occur. Okay? A transaction only occurs when buyers and sellers agree on a price to trade at. And someone has to get aggressive for that to ever work. It could also be a new participant entirely, right? We look at buyers that have orders in to buy, sellers that have orders in to sell, but someone could have not ever had an order in and then decided, I want to participate and I'll pay the offer or whatnot. So we have to eat through size to move. So we just talked about how a transaction gets done, but how does prices continue to move beyond just maybe transacting at the best available bids and offers? We have to eat through size. Okay? Let's look at some examples. A new order to buy 10 comes in at 56 cents. As traders, we'll often just say the cents instead of $1.56. There's no need for that. So we'll say 56 cents. A new order to buy comes in at 56 cents. What happens to the 15 offered at 56 cents?
It'll decrement.
Fancy term. We call it decrementing, right? It will be reduced by the quantity that was bought. Okay, so there was 15 there. After the transaction occurs, there will be 5 left because 10 came in and bought what was offered there. What happens now? Take a look at the numbers here. What happens now if someone places an order to buy 15 at specifically 56 cents? What happens? What do we end up with?
56 would be cleaned up, and there'd be 10 left at 156.
You got it. He said 56 will be cleaned up, which means all the offers are taken. You want to buy 15. There's only 5 available there. So you take those 5, and now you become a resting bid for the remaining 10 at 56. And it will end up looking like that. The 5 disappears, and the 10 is sitting there. And you'll be sitting there waiting to be filled. Some seller has to come down and pay your price, or either you have to move your order up again and get more aggressive to continue getting filled. All right, markets move higher. Why? Okay. This is kind of a quiz based on what we've talked about so far. It might be a little bit difficult. Markets move higher due to blank. Demand, that's one way to put it. Anyone want to put it a slightly different way?
Aggressive buying.
Aggressiveness. Markets move higher due to aggressiveness from buyers. Absolutely. Now, but markets move higher to, or markets move higher in order to what? Auction market theory.
Find equilibrium.
Find equilibrium. That's true. The market is always looking to facilitate trade and that kind of thing.
Sheepish sellers.
I'm sorry?
Sheepish sellers.
Sheepish?
Like passive, they're reluctant to sell. Sellers being reluctant.
Yes. Again, that would be more aggressiveness from buyers, kind of overpowering the sheepish sellers, right?
They're looking for sellers.
They're looking for sellers. Absolutely. Price is advertising, right? And if you want to advertise for sellers, you want to advertise better and better prices for them to sell at, okay? Markets, I would say markets move higher to do 2 things. One, they move higher to shut off buyers. Buyers are buying, they're driving the market up, and at some point it clicks in, this is too high right now. We're not willing to continue buying at these prices. And just as you pointed out, sellers, markets move higher to find sellers. They get attracted, they start to really slam it down. Okay? So now, Ricky, why do we go lower? Both things. It goes lower due to what?
Sellers are more aggressive.
Yes, and we move lower in order to
satiate that aggressiveness.
Right, so we shut off the sellers. They get weakened and no longer willing to be as aggressive, and buyers get more incentivized to buy, and they get more aggressive at those prices. Now, charts, which we haven't even looked at yet, we've only been looking at the order flow and how buyers and sellers transact. Charts, just as a basic primer, they simply reflect all the past transactions that have occurred. That's all charts are. They're just simply a historical documentation of all the transactions that have occurred. So, moving forward, how can we participate from a practical standpoint in this auction process? We have to understand order types, okay? What we can use to actually participate in this market. So the most basic type we'll talk about is what's called a limit order, okay? This is where pretty much everything we've talked about has been limit orders, okay? You just may not have known that term. people are being stingy. If you want to buy, you say, I'll buy at this point or lower, but I will not buy higher than that price. Sellers say, I want to sell at this price or better, but I will not come down. I'm stingy with my price. That's a limit order. You would call them a buy limit or a sell limit, just to be clear there. Market orders. Market orders are those aggressive people. Okay? A market order, when you hit buy market, it says buy it at whatever the best price, wherever that price is, someone is willing to sell. So a market order is those participants that really want to get aggressive. Okay? And what that means is if I want to place a buy market order, that means I'm willing to pay whatever I need to pay to find whatever seller will sell to me. Okay? So if there's a huge spread, as we've learned, a bid-ask spread, and you hit buy market, you're going to pay that spread there. Okay? You're going to pay that best offer that's far away. If it's a very liquid market, not a big deal. They're transacting penny by penny, and you hit buy market, you just get filled at the offer, which was only a penny away. Okay. But we want to, again, keep in mind that as we progress through these courses, we actually want to track aggressive behavior. Okay, that's something we're going to be looking at and giving you tools to track that behavior. So again, just placing a market order can be dangerous and can give you an uphill battle in profitability. Okay, again, just to be clear, if there's a wide spread and you want to buy, you have to pay all the way up here, and the market has to trade. Those bids have to keep stepping up and moving all the way to here just for you to start to break even. Okay? If you buy and then decide you want to get out and hit a sell market order and you sell, you've lost this much, right? Stop orders is another type of order we can use. Stop orders, you use the opposite of limit orders. So if I want to buy with a limit order, it's going to be somewhere below price, because remember, I'm stingy. I only agree to pay this. I'm not going to pay any higher. A stop order, on the other hand, you're saying, I only want to buy if price goes higher for some reason. Okay? There's two main reasons why someone would use that. Most commonly, stop orders are used to exit positions that you're currently in. Okay? And we'll talk about that in a moment. And another reason is traders that trade what's called momentum. Okay? They don't want to enter a market unless it begins to move in a direction. So what we could do here, you see that the bid and the ask is 56 by 57. That's where that market is trading right now. Okay? We'll say the last price was traded at 56. And you, for some reason, you know that for your methodology, for your trading style, if price gets up to 59 cents, if it gets above 58 cents, I want to buy. I want to get long. I want to participate there. This market is going to do that. It's going to sit there. It's not going to do anything until prices start to trade at 59. Okay? Then it's going to become, this is very important, a market order at that time. There's different ways to do it. You can place what's called a stop limit order, which becomes a limit order. But most just the general sense of a stop order is typically referred to as a stop order that becomes a market order. This is great for futures. Most futures platforms offer very easy, almost algorithmic functionality with OCO brackets, okay? And OCO stands for one cancels other. And what you can do is you can attach a limit order and a stop order, an entry order and an exit order. You can attach an entry order to a stop loss and multiple limit orders to take profits as a trade goes in your favor, all with the click of a button. You can structure it to say, okay, I want it to put it 10 and 20 cents higher and 10 cents lower than wherever I get in. And all of these orders, what's great about them is if that one fills, you don't have to worry about the others. They begin to cancel and reduce size to fit your actual position size perfectly. A little bit of an advanced concept, but as futures traders, most every platform you have access to will give you really, really good OCO functionality. So, when we think about these orders being transacted, when we think about this auction occurring, think almost back to the car dealership and all these people buying and selling cars and dealers offering sale prices and all these kind of things. These things are complex. Financial markets are extremely complex, okay? There are so many participants in these markets. We have hedgers, people that are only placing orders to hedge a certain risk. Hedge means to protect a risk or to neutralize a certain risk. Oil refiners need to hedge. They know that they're going to have to buy a lot of oil maybe 3 months down the road. They don't know what the price of oil is going to do in that time. Price of oil could go very, very high, and all of a sudden their bottom line is hurt because their raw good that they're taking and refining to sell something is now more expensive, so their profits are hurt. They can hedge. Pension fund endowments making long-term positions with massive, massive quantities of size, okay? Very large participants. Hedge funds can take a number of different approaches, but they're generally very large participants, and they can drive markets, move markets. We have swing traders who are buying today because they plan on selling 2 or 3 weeks from now or 6 months from now. We have day traders, like the majority of us here today, where we're looking to get in a position and capture a nice move intraday, just in one day. Scalpers, which there are also some of us in this room, we're looking to look at a small turning point, order flow, buyers becoming aggressive, get in, get a little move in our favor, and get out. That's kind of a scalper, right? Just very direct little moves. Then we have the infamous HFTs, high frequency traders, who are just ding, 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 just trading, I don't know, 1 million times a second. I don't even know what the numbers are, but it's just extremely fast and rapid. All of this is occurring at the same time. This is complex. We can never truly know what's happening or what will happen next. We just can't all the time with certainty, okay? It's too complex. It just is. And this is important to understand at the very beginning. And that may seem confusing. Well, how do we make money trading? We'll get to that. How do we make or lose money in a more rudimentary sense? Either by being long or short, okay? Long means that you have bought and you make money if it goes up. Short means that you have sold, okay? I know it's confusing for beginners. It's much less confusing in futures than equities. But you can sell first, okay? And you'll make money if it goes down and lose money if it goes up. And then you buy it back later, okay? And we'll talk a little bit about that here. So going long, this is just an example. The line here is the market movement, the price that's being traded, or price is. We're coming into an area, we buy, okay? Let's say we use a buy market order, okay? So we get long, we make money. Here's our entry point. Here's our break-even line right here. Anything, as price goes above that, we make money. If price goes below where we get in, we're losing money. The opposite is for a short. You sell first, okay? Just accept it. It is what it is. We can sell first and buy later. You can go short, which means I'm betting, I'm putting my money down that says I think this is going lower. I will make money if it goes below my entry point. I will lose money if it goes above my entry point. One of the best things about futures markets is that it's just as easy to go short or long any day of the week, no matter what type of movement there is. How do we exit a position? Okay? If you're currently long, That means you have bought. You must sell to get out, else you still have position on, you still have risk on. If you're short, you have to buy to exit your position. Okay? So let's do a little quiz here. We're long 5 contracts of a futures market. Then later we sell 4 contracts. What's the result? We are still long 1 contract. That's very important to really understand as a beginner just starting out. You have to make those match up. If you're long 5 and you only sell 3, you still have 2 long. So if you want to get what we call flat, which is no position, you have to match those up and do that. All right, what does this all come down to? All the auction, all the buyers and sellers. We're looking to get into trading. We're looking to get into markets. What does it come down to? Risk reward, okay? How much do we have as we see and as we analyze markets, and we'll get into analysis later, how much can we make on a trade, a potential idea, and how much could we lose, okay? And what we want to do is stack that in our favor. When we're right, typically, and there's different styles and subtleties, but typically, as a trader, when you're right, you want to make more than when you're wrong, you want to lose less, okay? So we call that ratio of potential profit and loss our risk-reward ratio. This is typically used backwards, okay? I know some people do different things, but I'm a fan of saying this offers 3 to 1, right? Which means 3 units of reward for 1 unit of risk. But we call it risk-reward, risk:*reward, but it's really reward-risk, the way most people say it. So if you hear someone talk about a 5 to 1 opportunity, they're not saying they're risking 5 units to make 1. It's the opposite. Expectancy, okay, or an edge, okay? There's an actual formula for it. Your win percent, which is how often you're right, times the average size of your winner, how much you make on average when you are right, okay, minus your loss percentage, which is the same thing as 1 minus your win percent, okay? If you're right 60% of the time, 1 minus 60% is 40%. You're wrong 40% of the time. For your loss percent, times the absolute value, because I have a minus right here, of your average loser, okay? If that is positive, if that formula comes out to a positive number, you're making money. If that comes to a negative number, you're losing money. And we can track how good our edge is by tracking this. Amateurs, most everyone that starts out, here's something that we can help you with right away. Don't focus so much on win percent. Don't focus on being right all the time, okay? We will talk so much about this later, but as a trader, you don't want to focus on being right on this trade and having your analysis prove you right and let your ego get involved there. You know, a lot of very, very successful traders are correct half the time. A lot of very successful traders are correct less than half the time and make fortunes, right? I'm about a 42 to 45% win percent trader myself. Amateurs focus on win percent. So focus on putting risk reward in your favor. And if you can be right half the time, you'll be doing good. One other misconception that many traders have, and you know, people that talk to me about what I do, or my family will ask me a question, or they'll say, "Hey man, where's crude oil going to be in 6 months?" You know, I don't know. How would I know that? Let me tell you about auction market theory, Mom. Right? What we do as traders is really more so reacting to what is, rather than some crystal ball where we're saying, "Oh, the market's going to go here," you know. We don't really do that. So that's a subtlety, and we kind of laugh about it here as we talk about it, but so many beginners and whatnot, people that don't really understand trading, they think it's about being right all the time and about predicting what's going to happen next. And especially when we talk tomorrow about our belief systems and whatnot, we're really going to put that down. Trade what is. We can use market profile like we talked about to see the overall auction, where volume's drying up and whatnot, where value is. When we have a new information that takes us into a new trend mode, where's an area of prior value that we may revert to, okay? Very important stuff. We can use order flow on the micro scale, right? Reading what buyers and sellers are doing on a moment-to-moment basis to help us time our entries and trade within the overall context of something like volume at price, volume profile, market profile, that gives us a structure to trade within, okay? So we learned auction process, how markets move, why they move, how we can participate with various order types and actually trade, how we make or lose money being long or short, and what trading is. It's about having a positive expectancy. It's about putting risk reward in our favor.